I would say so, mainly because many people have variable interest rates. And if rates have moved up, you've seen a bigger impact in Sweden than you've seen in many other European countries. So domestically, consumption is down quite a lot. Construction is down quite a lot. So people are struggling quite a bit, I would say.
What is the catalyst going to be for change there as well? Because when I look at Sweden, and I do spend a vast amount of time looking at the economy there, I see potential for Germany to go the same way. And I think Sweden's in a little bit a deeper problem, well, you mentioned on construction, than Germany at the moment, but I think Germany might be going in the same direction. What's the catalyst for getting out of it? Is the government, is Mr. Christensen doing something that's going to be very proactive?
I mean, first of all, to the extent that Sweden had a more negative impact from rates going up, Sweden will have a more positive impact when rates start to go down. So I think that's going to be the main sort of cyclical trigger.
It's the Riksbank you're looking at?
It is the Riksbank, I think. If you look at our economists, they think that next year Sweden will have a 3% GDP growth. So that's clearly higher than the average in Europe. So I think you'll see the reversal at some point. But then Sweden also has a very low government debt level, so you could see more fiscal stimulus going into next year as well.
Well, I mean, we know that they're going to up defence spending because, let's be honest, it's nowhere near the 2% level that they've promised to do now. But just on that Riksbank point, before Karen comes in as well, if we're going to have a 3% growth rate in Sweden next year, that's going to be difficult then for the Riksbank to cut aggressively, isn't it?
Well, I mean, historically we've had 3% growth without inflation. Now we've had low growth with a lot of inflation. So the correlation between GDP growth and inflation, I mean, it's not that clear.
The net interest income story is going to be a slightly more challenging one for all banks when we see those rate cuts. And I'm just looking through your numbers from the last set of earnings, and you can see that there's already that fade on the net interest income in the fourth quarter versus prior quarter, dramatically so versus a year prior as well. What happens from here in terms of how you manage that journey?
Well, I mean, if we do have rate cuts, I think it's very likely that net interest income will start to go down. It's going to be a reversal what happened when rates went up. If you look at deposit betas, so to what extent have Swedish banks passed on rate hikes to customers, it's been the highest in Europe. So when rates start to go down again, the impact should also be less in Sweden because we've passed on so much. So you do have a lot of deposit accounts where you can cut the rates on the way down. So I think it will go down, but it's not going to be as dramatic as when rates went up initially, because starting out, you started at zero, and when rates went up, you had a very large impact on NII. At these kind of levels, rates at 4%, when rates are cut, you'll see a negative impact, but it's not going to be as large as on the way up.
I want to use the word resilience because it was something that came up a lot in my conversation with the CFO of HSBC yesterday. He was talking about the resilience in the UK and the resilience is seeing in a lot of consumers elsewhere. But is resilience going to be a negative in the sense that we've still got stickiness in inflation? Getting back to the 2% target for a lot of central banks could prove challenging from here. And even if we do touch 2%, could we go back up again because of this resilience we're seeing in consumers despite higher interest rates?
I don't know. I mean, it's tough to say. We just had inflation print coming out this morning from Sweden, 2.5%. So it's not that way off, 2%. So it's very close now. And if you look at 3 or 6 month annualizing that, it's around 2%. So whether that's sort of a temporary way down to 2% and it's going to go back up again, I mean, I can't say.
I mean, you say you can't say, but if you look at the patterns, the strength that you've got in your own client base at this point in the cycle, that must be unusual versus other economic cycles where you start to go into a weakening trend and we're talking about rate cuts.
Yeah, I agree. It's puzzling, to be honest. It's been much stronger than people would expect. Had you said 2 years ago we would have rates 4 or 5 percentage points higher than we had back then, you wouldn't expect the economy to be as strong as it is. So it is a bit puzzling. I mean, there are maybe some arguments why that is. Pandemic stimulus is maybe part of it. You had a lot of savings going into this. So a lot of pent-up demand. Maybe inflation was more driven by supply rather than demand. So there are so many things in there. And I can't say really why you have that strength, but it's clearly a stronger economy than you would have expected a year ago.
I just wonder if you've cast your eye over what the ECB has said in the last 24 hours. I know obviously you're more focused on Sweden, but obviously you do operate, of course, in the Eurozone as well. Improving liquidity, an operational review, biggest change in decades I've heard as well. Just wonder what your reaction was really to what is hopefully improved liquidity for banks and less volatility in the financial markets.
Well, it sounds good. I think I agree with most of that. I think what people have underestimated is the strengthening of the European banking sector post the financial crisis. So you have this knee-jerk reaction in the market still that if something happens, banks will be impacted quite negatively. And many investors, many analysts out there haven't really taken into what extent European banks' balance sheets have improved since the financial crisis. It's been tested a couple of times now with the pandemic, now more recently, and you can see it's clearly more resilient. And I think over time, investors and market actors will understand that you've seen a clearly sort of structural improvement of European banks' balance sheets, but it will take some time. People still don't trust it completely, but you'll see it over time.
Tell us a little bit about SEB and where you see the biggest growth drivers at the moment. I mean, my dear colleague here, she spends a lot of time looking at the digitisation of banks as well. I mean, I presume that's an exciting area, that combined with AI, where you're going to see some big cost cutting. But is there something more granular economically you see a growth area as well as the digitisation?
Well, definitely when it comes to infrastructure investments, we know that there's going to be a big transition out of fossil into renewables. There will be large investment, both public and private. You need to see more collaboration there. And this will be a mega trend that will go on for some time. We've seen strong growth in our project finance for the last couple of years, and I think that will continue. So being able to take part in big wind parks, offshore wind being built, and so forth, that's going to be a decade-long, I think, investment cycle, and we really wanted to be part of that.
What jumps